My name is John Jacobs, and I love being up here. I got two great intersections here. I was at NASDAQ for 32 years and retired in January, running the index and data business there, and still consulting some for NASDAQ. And then I just joined Georgetown, as Adena mentioned earlier, as a distinguished policy fellow. I've known Adena since 1993. I think I've known Rena since 1990 or 1989, somewhere around there. So I go back with both these people a long way. So when I make comments about Adena, she knows as much about me as I do her, so there'll be great comments, obviously. And it is an honor, privilege, and pleasure to introduce Adena. I did want to point out, I'm glad Rena pointed out that there will be probably a whistle going off, some testing later on. And because I wanted people to know about that, because when you have the president of the largest exchange company in the world on a day that Fed's making an announcement, when alarms go off, you want to make sure you understand and put it in context. We have much more elegant ways to let her know if something's going on, so I'm sure it'll be just fine. So, as I said, I've known Adena since 1993. She is a person who just comes with tremendous energy, passion. She has been a pleasure to work with all these years, and even when she left NASDAQ and went to Carlyle, which then she took public and then brought to NASDAQ and came back. So it's been great. I watched the debates last night, and I thought it was interesting at the end where Tav was asking them what their code name would be. Because we have a code name for Adena, for those who know her. And we called her Energizer for years because she is unstoppable. She never stops moving. And just to put that in perspective, Stockholm, New York, Rockville, and D.C. And that's in the last week. And she fit in a half marathon during that time frame. So if you want to talk to somebody who is high energy, never stops going, and has a tremendous capacity to see around the corner, see into the future, but also knows every single detail of the massive businesses that she runs, it's Adena. So I don't think we have a better session here. And so with no more ado, I'll introduce and let Rena and Adena take it over.
I'm just going to disappoint everyone from now on. Thank you, John.
Well, let me add my welcome, Adena. Welcome to Georgetown and the McDonough School. We are thrilled to have you here today for this conference. And just for the sake of some of our students who are in the audience, can you tell us, what does the president of NASDAQ do?
Sure. So I actually have a co-president, so there are two presidents within NASDAQ. I manage everything other than the trading business, so it's kind of funny because this really is a market structure trading conference, and while I'm very familiar with it, I don't actually oversee the trading businesses themselves. I manage the listings business, our data and information services and an index business, our corporate solutions business, which is a software business that provides investor relations and PR, public relations services to corporates around the world, and then our market technology business. And a lot of people don't realize it, but NASDAQ, not only do we run our own exchanges, but we provide the software that powers over 100 exchanges around the world. So we have this great stat that 1 in 10 transactions in the world occurs on our software.
We're going to take a little bit of credit for that at Georgetown. Way back when the market started opening up in Eastern Europe, at Georgetown, in partnership with NASDAQ, we used to do these conferences on market microstructure, really telling a lot of these countries, how do you start a market and use NASDAQ's trading platform and technology? So we'll take a little bit of credit for that. That was a long time ago. So over this time period, how have the markets changed? How has a place like NASDAQ changed? What's causing that change? Technology, global competition? What's going on?
Sure. Well, I think there are a couple questions there. So one are how the markets have changed, and then also how has NASDAQ changed. So I'm actually going to start with the NASDAQ question first. 10 years ago, NASDAQ was a U.S. cash equities exchange. And so everything we did was related to the U.S. cash equities business, our listings business, our data business, our transactions business. And today, NASDAQ really is, hold on one second. NASDAQ really is a global technology company that also runs exchanges. So we have U.S. cash equities and options, Nordic cash equities, Nordic options, Nordic futures. We also have a much broader index business than we had before, our market technology business, our corporate solutions business. So we really provide financial technology that powers the financial markets and provides the opportunity for economic growth globally. So I think it really has changed dramatically over the last 10 years. In terms of the markets themselves, they've also changed dramatically over the last 10 years, and I certainly think technology has had a huge role to play there. But also, I think regulation as well. So a combination of regulation and technology, I think, has really fundamentally shifted the markets towards everything that we talked about this morning. But in terms of automated trading decisions, speed has obviously just picked up, although speed's always been an issue in the markets, as well as just the complexity and the network effect associated with how the markets are interconnected today.
So we're talking mostly about trading at this event. But the whole purpose of markets is the whole capital raising process and allocation of capital in the efficient manner. How has that changed?
Actually, interestingly, I don't think the process of going public has changed that much in terms of looking at capital formation itself and the way that companies come and raise money. Raising money is still very much a human experience in terms of going out and marketing your company to investors, making them feel that they can trust you, but also they can also, what I'll call trust but verify through the numbers and disclosures. And then bringing that, making that commitment of an investment is still very much a human decision. And therefore, the process around it is still very, very similar to the way it was 10 years ago. Of course, once they come onto the exchange, the experience of going onto an exchange in the first trade has changed dramatically. And in fact, NASDAQ over the last 3 years we have dramatically changed the way that IPOs open on our market, including a major enhancement we launched this week. And then, of course, once it gets into trading and secondary trading, it is highly automated.
So capital raising is important, and that's a big part of the financial markets. Where does market microstructure fit in? Why is market microstructure so important in the capital raising process?
Well, at the end of the day, I think that it's very important that if an investor is able to, if they make the decision and they are trusting the company to invest in that company, that they have access to liquidity instantaneously, and they feel that when they're ready to sell that stock, that they can sell it efficiently and effectively with minimum price movement. So micro market structure, it plays a huge role in the ability for that liquidity to work, and that is, at the end of the day, a fundamental part of the initial value proposition. It's really funny because having worked at Carlyle for a few years has nothing to do with micro market structure, but when they make an investment decision, the vast majority of their decision is about how they're going to exit. So even though they might hold the investment for 3 to 5 years, a huge part of their decision is making sure that they know they can get to an exit. So if you're buying a company in an IPO, I think a big part of that decision is going to have to be, making sure that if you make that investment to begin with, that you know that you're going to be able to exit that investment efficiently, and that's where market structure plays a huge role.
We'll get into the specifics, but broadly, in your point of view, what's working well in terms of market structure, and what are the problem areas?
Sure. Well, I'm sure you heard a lot of that already. So I want to try not to repeat everything that was already said, because that's often a risk when you have a lot of us up here all day. I do think that certainly the capacity that our systems can handle, whether across the entire ecosystem, is absolutely incredible. The speed at which we can manage trading activity is incredible. The network and the connectivity of the exchanges, while we can argue that there's too much fragmentation, I do think that the July 8th event does show that having that network and the connectivity of the exchanges can be very beneficial, and having the resiliency that the exchange environment has. And I think, obviously, we do believe that spreads have collapsed. And so you've got very narrow spreads. You've got an efficient way for individual investors to access the markets through electronic brokers. And very much anyone, it's basically a lot of self-directed investing, and they have a very efficient means to get to the market. So a lot of good things are occurring in the markets today. I think that where market structure, we have some areas of focus and need for improvement are in the areas you've already heard about. Every time we have a moment of stress in the markets, it gives us an opportunity to learn. We learn what we did well, and we learn where we can improve. So I do think that the way that the stocks to be honest, did open on New York on August 24th, is an area for improvement. And I think that I'm sure that there'll be a lot of focus around that. Having those stocks not open at 9:30 created a lot of other dislocations in the ETFs and other instruments, and frankly created uncertainty in a time when all people wanted was certainty. So that is an issue. I think that also the price dislocations that just existed during the day in terms of pockets where demand just wasn't there to soak up the supply in the marketplace, that's an issue. And I think I heard someone on the panel say, it's impossible to ask a market maker to essentially catch a falling knife. You just can't provide enough incentive for them to be willing to do that. So how do we manage that and create the right supply and demand mechanism during the day in those stress days? And of course, the ETF market structure should be different than the underlying stocks in some ways. I think we have some very specific recommendations that we've made to the SEC on that, related to limit up, limit down parameters. The fact there was no limit up, limit down for those stocks that had not yet opened on New York, that created issues. And should an ETF open if the underlying stocks are not yet open? So there are definitely areas where we can improve there as well.
So early this morning, there were a couple of comments. I think Andy made one about, do we need a timeout in terms of speed? And other people said, are equities trading way too fast? And at the same time, it was said, well, there's innovation, there's technology, so there is going to be higher speed. Where are you on this?
Yeah, I mean, I've been in the markets now for a long time, but way before I was involved in the markets, I mean, speed has always been an issue with the markets. There has always been the ability for you to get faster to the button tree to place your order, or to get faster to the post and to yell louder in order to be heard by the specialist, or ultimately to have a faster connectivity based on the investment you make. The fact our role in the markets is to make all of that equally accessible to you. So our role is to make sure that to the extent that there are firms that want to invest in technology, that they have equal access to the same technology, they have equal access to our data centers, they have equal access to our data. And I think that while there's been a lot of discussions around that, our role is to do that, and I think we do it well. So speed has always been part of the market. It's been part of the market since I joined in '93. I think it will always be part of the markets. However, I do think there are aspects of market structure where speed is prioritized over other things because of the market structure that exists. So price time priority means speed matters above all else other than price. And that creates an incentive structure amongst the market participants that therefore they prioritize speed above everything else. What about fill rates? What about size? What about other factors that could drive a best execution decision? Those are no longer factored into a lot of decisions because of the regulation that exists today. So there are ways that you can introduce I think some flexibility in the system that means that speed is not paramount above all else, but at the same time, I do think speed will always be part of the markets.
So we don't want to repeat everything that was discussed earlier this morning, but there's no getting away from July and August and what happened in the treasuries market. Anything to add what happened on August 24th and in addition to what was already discussed this morning?
Well, I actually think I covered some of that already. So I think, as I said, we'll be learning a lot from that. I do think we'll be focusing on the ETFs. I think Chris said it well. ETFs are going to be are already a huge part of the investments made in this country, and they will continue to grow in importance as a major area of growth in investments, and therefore they'll continue to grow in importance in trading. And we have to recognize that, and the market structure does have to catch up to that. So we'll be very focused on that as well.
Okay. So going back to sort of capital raising and the role of capital markets, broadly, what are the big challenges you think in that? The whole, Larry Fink has been talking about long-termism and short-termism. Mm-hmm. And what is the impact of what's happening in that area?
Yeah, I think that that is a great philosophical question that I spend a lot of time thinking about. As I go out and talk to issuers, companies that are listed on NASDAQ and other exchanges, their major area of concern is short-termism. When I talk to companies that are not public, who now don't necessarily have to go public because they can have 2,000 shareholders without going public, and they can mature more as a private company, and there's frankly plenty of access to capital as a private company today, they think a lot about short-termism as a reason why not to go public. And that is very concerning. That is a fundamental flaw in the public markets globally. It's not just a U.S. issue, although I do think there are elements of the U.S. markets that exacerbate the problem. So when I sit down and talk to issuers, what is the first topic that comes up? Activism. And I think activism can be a good discipline. I do not want to sit there and say that activism is wrong, but I do think that there are certain practices that activists take on that probably need to be monitored, at least. So one example with that would be an activist comes in and they get themselves a couple board seats on a company's board, and then they pay a consultant to be the board member. And to me, at that point, that person is compromised. That person is not a fiduciary to all shareholders. That person is a fiduciary to one shareholder or a small group of shareholders. While I would love to say they shouldn't be able to pay them, I think that's a harder thing to get done. So the better thing is that that payment should absolutely be disclosed. Every shareholder should know that that board member is not independent. And I think that that's an important thing for us to put in place. So that is one thing we're going to be working on. I think that also activists also and other investors will use shorting of the stock as a technique and a strategy in the process of what they're trying to do and accomplish with the business. And while that's a very legitimate use of the markets, and shorting is actually, frankly, a very important part of our markets, I do think that short interest should be properly disclosed, just like long interest is disclosed. So at the 45 days after the end of every quarter, all institutions have to file a 13F that says what their long positions are in stock. My view is that companies that are shorting stock should have the same obligation, so that a company knows what strategies are being deployed by every investor. So those are the types of things that I think we can do to help create a fair environment without certainly saying that activism is good or bad. It's more just creating a fair environment and allowing the companies to have the proper information to manage that kind of activity.
Yes, I want to talk about issues that have not been discussed this morning. NASDAQ's private market. Mm-hmm. What was the motivation, and what do you plan next?
Sure. So NASDAQ private market really was a reaction to the Jobs Act, and it goes back to the issue that companies can stay private longer. The Jobs Act allows companies to have up to 2,000 shareholders before they have to go public. And while the Jobs Act really was meant to create a more flexible environment in which to go public, so you have confidential filings and you have other things, you can test the market now. There are a lot of great things, frankly, in the Jobs Act. There is that one provision that allows companies essentially to stay private longer, because there are companies that have gone public because they were forced to be a public filer because of the 500 shareholder limit before. So as companies are able to stay private longer, that means that they might issue equity in early rounds, they might have early investors, or they issue equity to their employees as they grow up as a company, but they might stay private for years. And there's a huge number of companies that are worth over $1 billion that are private, and they've been private for a long time. So at some point, they want liquidity. Their early round investors want liquidity, their employees might want liquidity, and they want to seek out the ability also to get some fresh new shareholders in their stock as a private company. So NASDAQ created a private market that have two key services. One is we help them manage their cap tables, so we have an equity management solution that allows them to track all of their equity through all of the rounds of fundraising to all of their employees, and frankly track that shareholder count with precision, and manage all the tax issues associated with the equity ownership. So we first have a cap table management, equity management solution, and then we have a liquidity management solution. So if a company chooses to have a liquidity event, they often will find their own buyers, and they will set the price and negotiate the price with those buyers today. But we have a solution that essentially allows for the transfer of those shares to occur very, very seamlessly and easily across our platform. So it's a workflow tool. Employees can basically, and investors can state their interest in selling. We go through the process. We do DocuSign, electronic transfer of the agreements, and it is done. So it's a much smoother, easier way to manage those liquidity events. At some point, there might be an interest in companies in actually having a price discovery event around that liquidity event. And we have built the ability to accommodate that as well, but that is not how people are using it today.
Is it meeting your expectations, or is it too early to tell?
Actually, it's in my opinion, it's exceeding our expectations in terms of two things. One, we have over 100 companies using the services today, and we launched it just over a year ago. So we're pretty happy about that. Number two, the companies that are using it are much bigger than we thought. So we had thought that companies early in their life cycle would choose to use the equity management tool and would kind of grow up and go into a liquidity event. And instead, the majority of the companies that are choosing to work with us are already unicorns and large companies, both in the US and in Europe, which was also a surprise. So we've had a lot of demand for the equity management solutions in Europe from some large technology companies. So we're actually extremely pleased with the progress so far.
Excellent. So moving to another area of innovation at NASDAQ, blockchain.
Yeah, the blockchain. I forgot to mention that.
Why is NASDAQ getting into this business? How is this going to change the financial infrastructure?
My guess is that may be a topic for the next session, too. I already said to Frank he should be ready. Anyway, so blockchain. Well, the reason why I said I should have mentioned it is because we are doing a proof of concept around the blockchain in the NASDAQ private market. So we believe that the blockchain has the ability to really cut down on the settlement cycles associated with securities trading. It is kind of amazing to us that a trade can occur in a nanosecond, or at least let's say a microsecond. Maybe moving to nanoseconds at some point. But the settlement occurs over 3 days. So the money can't transfer, and the stock doesn't actually trade hands for 3 days. And that is just the way the system has worked. And there have been a lot of attempts in the past to do straight-through processing and other things to try to cut down on that settlement cycle. And there are other markets in the world who settle faster than we do. So we are the most advanced markets in the world, and yet there are other markets that settle T+1, T+2, and we're still settling T+3. So I think that if you think about what the blockchain does, and I think there'll be a lot of discussion about this for a long time to come, because it will have such an impact on the ecosystem, there's going to have to be a lot of investment made. But the theory of it is that if you can manage the securities ownership on a ledger, electronic ledger that's distributed and essentially fully distributed and secure, then as those trades occur and transfer hands, you can transfer that ownership instantaneously so long as the cash moves with it. And if you have the proper wallets in place and the ecosystem around it, that cash can transfer instantaneously as well. So the process, that is the theory. It's a matter of proving it out with technology. So one of the things we're doing in the NASDAQ private market is we are going to give our issuers the option to put their cap tables into the blockchain, and then when we have a liquidity event, to use the blockchain to transfer those shares. So there is no contract, no piece of paper. It's completely done electronically. We will also likely, although we haven't formally made a decision yet, offer it on a private chain or the public blockchain. So, so that we can also experiment around the use of a private chain versus a public chain. So it will be very, very interesting to see how it's used, if it's used, but it is a great chance for us to build out the infrastructure to support it in a closed network.
Are there any regulatory hurdles to doing it?
Within the NASDAQ private market, no. Within the U.S. markets or any other public markets, I would say that there's a huge regulatory component to it, yeah.
Okay. So another area of innovation, robo-advisors. And so where do you stand between humans and technology?
So, well, first of all, I don't like the word robo-advisor. I know that's what everyone says. I like to call it electronic investors. I think they'd probably prefer to call them that, too. Well, I mean, it's certainly an amazing growing industry. I think that the industry's gone from kind of 0 to 18 billion in assets under management in a very short period of time. So clearly there's demand for it. So, and it is essentially a form of passive investing on behalf of a client who allows the electronic investor to essentially manage their money in an electronic way. And they're using algorithms and other things to make those investment decisions as opposed to a human being. And they are generally tracking beta. So I actually, for full disclosure, am an investor in one of them just to see what it was like. And I'm also an investor in T. Rowe Price, and I'll talk about that in a second. But in terms of I think that it's very interesting because they really do track beta in a very low net fees, and they do it in a tax efficient way, or that's their pitch, is to be very tax efficient, low fee. So your net return is higher in tracking beta than it would be if you put your money into other forms, other funds, or if you're trying to make direct investments into ETFs. So that is the concept. And I find it fascinating, I really do, because when you meet some of these firms, they don't have investors, they have programmers. And that is what they're investing in, is programming talent, not investing talent. Whereas if you meet with T. Rowe Price, and also for full disclosure, my father worked at T. Rowe Price his whole career and was a very successful investor. I believe in the value of human judgment. I believe I have a lot of money invested in T. Rowe Price funds. I am a huge believer in that. So, but it is, I think, a balance that's going to start to emerge in the markets. So I would say that technology is moving from the trading decision to the investing decision and moving successfully in that way. The use of ETFs is very much a part of it. I believe over time that they will generate alpha strategies as part of electronic investing. And you do see some hedge funds that are already doing that very successfully. So I think it's going to be a part of the balance of the markets that will exist in the future. Will it all go to electronic vesting? I don't believe it will. I think arbitrage opportunity will naturally develop if you have everyone using electronic investing, because the herd mentality will just move to the machines, and you're going to find that there's probably a lot of opportunities to invest in other ways as a human. So my belief is it'll be a balance, but I do believe it'll be a growing part of the business.
I could go on and on asking Adena more and more questions, but I know the audience wants to ask you tons of questions also. So let's open it up for Q&A. Over here, please.
Yeah, we'll
There's
just
a
wait for the mic
coming up.
Yes, I was just wondering, as more companies are staying private longer, how do you see that affecting the public markets?
So I personally think it's healthy because, so in the context of all these companies staying private longer, we had 189 IPOs last year. We've had over 100 IPOs this year. So in a healthy capital raising environment, giving companies a plethora of choice on how to raise capital, I think is a good thing. And capital will be available to both public and private companies. So I think that why I think it's a healthy thing is companies that are staying private longer are doing it to mature further, so that when they come to the public markets, they're more ready. And not all companies can raise money in the capital markets. So biotech is a great example where we've had a very large number of biotech companies go public because it is a very accepted and expected path to raising capital. And there's an ecosystem around the biotech in the public markets that exists, and it's very much part of how they make money or raise money. So I think that there'll be pockets of companies staying private longer, but there's still many companies that are looking to the public markets. The other example would be companies that are private equity owned. They are not private equity owned forever. So private equity firms are not buying a company to hold it forever unless you're Berkshire Hathaway. So really they look towards an exit, and they're either going to sell it or take it public. So the public markets are there to be a very healthy way for them to exit their investments. So I think I personally think it's very healthy.
Other questions? Wow, Adena has covered so much that people are left with no questions. I'm going to ask you another thing. So obviously this morning we saw, and we see it all the time, New York Stock Exchange and NASDAQ, a good competition going on there. But what's happening globally? What does global competition look like?
Well, in the exchange space, global competition isn't nearly as advanced outside the United States as it is inside the United States. I think that many of the exchanges around the world really are still, I hate to use the word monopoly, but they at least are dominant in their markets. They usually, a lot of them own the trading all the way through settlement, so they're vertical. They have a vertical model. They're iconic in terms of the way that they are viewed by the governments of their countries. In many of the developing worlds, it is a point of pride to have a successful exchange. So as I said, we provide the technology to over 100 exchanges around the world. So I've had the pleasure around Asia primarily, as well as Europe, to really, and we also have exchange relationships throughout the Middle East and Africa, to look at and to work with them on developing their markets. And it is a point of national pride to have a successful exchange. So when you go to Indonesia, for instance, and I went there a few months ago, first of all, very advanced exchange. Would love to have some of the market structure elements that they have. They are highly electronic, but they have this whole museum on the growth of the capital markets, and they are trying very hard to bring more retail investors into the markets, and they view their role as a steward to the capital markets, and they treat their business that way. So it's very different. But I also think that obviously in the more advanced economies, there is a lot of competition developing, and whether you look at Canada, or whether you look at Japan, Australia, Europe, there is true competition in all those markets. And so it's very interesting to see how the changes and challenges they're facing as well.
On the listing side, what are you finding with ADRs?
ADRs are not as common today as they once were. And the reason is because I think ADRs were a great experiment, but the trading did not tend to move to the market where the ADR was listed. So oftentimes the trading would ultimately migrate back to the primary market. And because of, frankly, the connectivity that the broker-dealers have now to all of the world's exchanges, and the way that they are able to manage their order flow around the world, they don't need an ADR to be able to invest in a company that's listed in Japan or in Hong Kong, or in Indonesia for that matter. They can just go and access that market very efficiently, effectively, and cheaply. And that is another great example of where technology has been huge in making access to capital so much more efficient, faster, and cheaper for all of you.
There are several hands I see. Joanne?
Adena, NASDAQ has been a leader in having an index business within an exchange format. Now we saw the London Stock Exchange, of course, invest in FTSE Russell. So how do you see that as fitting in with the other areas that you're growing your company?
John is the father of the NASDAQ index business, and he's done a spectacular job of building that business for NASDAQ over the years. Indexes the index business is one of our fastest growing businesses. It is obviously benefiting from the beta that exists in the growth of passive investing. It has evolved dramatically over the last many years in terms of it really being more of a benchmark-oriented passive investment decision to an outcome-oriented passive investment decision with the growth of smart beta indexes. So NASDAQ today has about $105 billion of assets under management tied to our indexes, directly tied, and $40 billion of that is in smart beta indexes. And those didn't exist within NASDAQ 5 years ago. So we have very specific strategies that we've deployed, and we have a great team of people who focus solely on working with ETF sponsors to build these new indexes. So dividend achievers, the buyback indexes, the bullet shares indexes. And then we bought a company called Dorsey Wright in January that has essentially a relative strength model that they've developed into very successful ETFs. So my view is that I love the business, love it. I mean, really do. I believe you're only limited by your own imagination. It's wonderful to have a business like that. We've got great ETF partnerships, and it's fast growing. And so it is definitely a big part of what we see as the growth of our company. At the same time, the NASDAQ 100 continues to play a huge role in listing decisions. So the benchmark indexes continue to play very much a huge role across the rest of our business as well.
Another question here.
Hi, my name's Elise Goldberg, and first of all, thank you. And I second the call, Professor Angel, to have a full day to talk about the blockchain, as well as the role of the growing private equity market in the United States. So my question is more on the private equity side. What role has NASDAQ private market played in increasing cap table transparency for employees of these small companies, or sometimes very large companies whose compensation may be primarily based on equity for that company?
Mm-hmm. So I think that is the role, that is the purpose of the what we call exact equity tool, is to give the employers, but also the employees, the ability to see their equity and understand the value of their equity and how it's taxed and how it's treated, and then obviously give them the opportunity to have liquidity around it. And private equity owned, so whether it's VC owned or private equity owned companies, they do benefit from having their entire portfolio in this cap table service so they can kind of look across their portfolio. We'd love to get a lot of companies to buy our service that way. But that's still developing. But that is actually an issue because I think that a lot of the private equity and VC firms basically manage their cap tables in Excel. And it's static and it's often inaccurate, or it can become inaccurate because of all the different rounds of financing that the companies go through. So, this tool is specifically meant to manage that and to give them a lot better transparency and management of the equity. So that is our role here.
So is it PE firms that are kind of pushing for this, or it's issuers? Or is it both?
No, it's actually, we work directly with the companies, but we do also work with the VC community primarily. Not so much PE, but with the VC community. Because they see this as a way for them to be able to manage their exits more gracefully as well, or at least partial exits as they're preparing the company over time to go public. So I think that it is, we work with the VC firms, but we directly partner with companies.
Other questions? Well,
yeah,
sure, please.
So is blockchain settlement going to be the norm standard in the future, and when do we think that'll happen? That's a good question for the next panel. No, I keep setting up Frank. I think that I do actually believe that there's enough momentum in the industry to learn about it, and there's obviously a lot of money being poured into the technology today from the VC community. In addition to firms like ourselves, we just made a small investment in a company called Chain, as did a lot of other broker-dealers. There's, basically the mainstay of Wall Street made a choice to make an investment in that company. So I do believe there's enough money going into the technology itself. I believe that there's enough of a dialogue and a discussion going on around the concepts that I think that there's and the momentum to try to make it a reality. Now, I also think it's very complex. So when it's going to happen, I can't guess. I think that it will require a lot of changes among the banks and the clearinghouses, the CSDs, the exchanges. There's a huge ecosystem that's going to have to shift and be willing to embrace and accept this new technology, and frankly make a lot of technology investments themselves to be able to handle it, that it will take time. So I think you will see some experiments and proofs of concepts coming up over the coming months and probably the next year that will help us understand whether or not it can be a reality or not.
So without giving away any big information, what are some of the things that you're working on? Big projects that you're working on?
Big projects. Well, I think NASDAQ, we have a lot of different businesses within NASDAQ. So each one of my businesses has some really interesting projects that they're working on. So within the listings business, it really is the NASDAQ private market. We also have, as I said before, I've been working with the trading business to enhance the IPO opening process. And we did just launch yesterday, a new process by which the underwriters have the ability to see the book leading up to the IPO opening the first trade, to give them much more visibility into managing that first trade event, given the obligations and responsibilities they have as the lead underwriter. So there's a new visibility tool that we've provided them that's, in my opinion, fundamentally will change the role and the ability for the underwriter to manage our IPOs going forward. And we've made other enhancements to give all of our members the ability to look at every order that they have in the IPO book, know whether or not they will get a fill at the indicative price, and it updates every 5 seconds. So we've given a lot of tools out to the member firms and now to the lead underwriter to be able to manage those IPOs very successfully. And we've had a lot of positive feedback from the buy side and the sell side as we've gone through this process of enhancements. So very, very exciting. So I would say that's big because it really does change the way IPOs open on NASDAQ. And that's big. Anytime you do that, that's pretty big. I think that within the data and index business, we've really been focused on smart beta. and the growth and continued investment and in the smart beta space, and we're extremely focused on building out new strategies and working with ETF sponsors. So that's our big area of growth within the data business. In terms of the market tech business, post everything, it's all about post-trade. Post-trade and market surveillance. It is amazing how fast both of those parts of our businesses are growing. Market surveillance, we have a global market surveillance platform. It's been named the #1 platform for several years running, and it's growing like crazy. So we've been focusing on the buy side, embracing it also, in addition to the sell side. And then post-trade, clearing technologies, CSD technology. Every exchange in the world is looking at how they're going to be able to manage and clear OTC instruments going forward and the need for new technology around that. So a lot of big things happening.
Great. And that's going to be interesting. The next panel, we have Cynthia Main from PIMCO, who's going to be talking post-trade. So it's going to fit in very well. So, Adena, you are at Georgetown University. I have to ask you, there are students in the audience, and you're just a terrific role model. How did you get here?
Luck.
No, I don't think it was luck.
I mean, honestly, I was very lucky. I joined NASDAQ when it was still a subsidiary of the NESD. So it really was, I got a chance to grow up with the company. And when you do get the chance to grow up with the company as they professionalize their operation and demutualize from the NESD and went public, that generally is a period where there's a lot of opportunity. If you work hard, you say yes a lot, you make yourself available for every and any new project that comes along, and you obviously prove yourself out by executing on those projects, a lot of opportunity comes your way. And so I did get lucky. I really did. Lucky in timing and lucky in opportunity. And over time, then you continue to prove yourself out over time, and good things happen. And
in between the Carlyle years?
Yeah.
Right?
Yeah. So
happy to be back.
I'm very happy to be back. I love Carlyle. It's actually a spectacular firm, incredible talent. And it had nothing to do with the company. In fact, I really had a hard time making the decision to leave NASDAQ, and I had a hard time making the decision to leave Carlyle. But the role itself, I was the CFO at Carlyle, and while I like being a CFO, I love being the leader of a business. I think that I really enjoy working with clients. I really enjoy the pressure and the fun of managing P&Ls, and I find that that's a little bit more in line with what I'm passionate about. And of course, NASDAQ is an amazing company. I cannot underemphasize that. It really is an amazing place to work.
And I hope some of our students will have an opportunity to go work at this amazing company.
We do have a very active internship program. We have over 100 interns every summer. So.
All right. Please join me in thanking Adena for this great session.
Thank you.
Thanks so much.